Enlightened investors, I have some exciting news for those looking to dive into the world of passive real estate investing. Many have asked how I got my start in commercial real estate investing. Well, it all began with an event close to my heart. Multifamily Live is back, and this time it's online. This event holds a special place for me because it's where I got my start in commercial real estate investing. Imagine a virtual gathering where you can gain invaluable insights into how cash flow ready apartment buildings are the key to your passive income journey. Take the mystery out of passive real estate investing and step into the active side of the equation to gain a comprehensive understanding so you can invest passively with confidence. Whether you're a newbie or a seasoned investor, Multifamily Live is designed to cover everything from acquisition to asset management. You can be confident that you'll leave this event with a comprehensive understanding of commercial investing. Mark your calendars for May 9th to May 11th. Trust me, this is an event you won't want to miss. Ready to enhance those passive streams of income? Get your ticket now, and together, let's take the next step to enhance our financial well-being, to live abundantly and flourish in all areas of life. I'll see you in Multifamily Live. Hello, enlightened investors, and welcome back to Real Estate Investing Abundance. I'm your host, Dr. Alan. Thank you so much for being with us again today. I know you're going to love our topic and get a great deal out of it as we look at Legalese Made Easy, everything you wanted to know about syndication and private real estate funds. With us today is attorney Stephen Rinaldi, and he has handled private offerings of securities for over 32 years. For a wide range of industries, including app development, private hedge funds, private real estate funds, agriculture offerings, and recreational facilities. So, Stephen, take us into the show and share a memorable experience that helped you to be who you are today.
Maybe the most memorable experience that helped me to be who I am today is probably just back when I was a little child, my grandfather just encouraging me to become an attorney, encouraging me to study hard, work hard, and just letting me know that nothing is going to come easy in life. You're going to have setbacks, but if you work hard and you're a good, honest person, you give people a fair price for the services, things will work out in the end.
Was your grandfather an attorney?
No, he was a banker.
A banker.
He was a commercial lender, as was my father.
So why was becoming an attorney important to your grandfather?
He always wanted my sister and I to go into professions, do something for others, and it really is a great chance to do something for others and change others' lives in a positive manner. Mm-hmm. I suppose the other significant experience I've had came in the last 2 years. I had a client who wanted to develop an app, and the app basically is used by homeowners and contractors. The homeowner loads the app onto their phone, and it takes pictures of their kitchen, living room, dining room, whatever. And it will produce exact measurements.
Wow.
Right. And the contractor can download that app on the contractor's end, and the homeowner sends them the pictures, and the contractor can see the measurements and produce a quote, with at least a rough quote, without entering that homeowner's house.
Wow.
So it gets a little bit out of the fear and uncertainty of having strangers in the house. And I did 2 rounds. I did a family and friends private offering of securities. It was a Rule 506B offering for the first round, and the second round was a promissory note offering or convertible note offering to accredited investors. Today, that business is valued at $10 million.
Wow.
Went from 0 to 10 million in the span of 8 months.
Wow.
that's just kind of life-changing, realizing that what you can do positively to impact others' lives.
Yeah. Fantastic. Wow, that is amazing. Well, let's get into to the legalities of how to actually form a structure for a syndication.
What I commonly see and usually see is there are two classes of LLC membership units. A managing membership class, which used to be the old GP class when people use partnerships, and a investing member class, which used to be the old limited member class when people used partnerships. And the profit and loss splits between the two can vary considerably. Many times, but not always, the investing members get a preferred rate of return, be it 6% or 7% or 8%, until they've recovered their original invested capital. After that, profits and losses usually get split between the managing members and investing members. It could be 60-40. It could be 65-35. It could be 70-30. It could be 75-25. It could be 80-20. When it's 80-20, I tend to see a lower preferred rate of return. That means it could be 50-50. Even seen that. Mm-hmm. It all depends on what the investors need. It all depends on the strength of the project.
Yeah, the stronger the project, the higher the split for the general partners, generally speaking, has been my experience. Is that what you've experienced?
Yes, yeah. Exactly, yes.
Well, so that breaks it down in a general perspective there. So where do we start with this process? What is step number one?
Step number one is the person has to identify the project, what they want to buy. What are they looking for? What class of multifamily, in what cities? What's the vacancy rate? How much am I going to have to sink into repairs? How much can I afford to borrow? What do I need to put down? Is this a situation where the project is underperforming? Meaning, let's say you're getting rents on one bedroom at $900 a month and the local market is $1,200. If you fixed up the place with turnover, can you raise it up to $1,200? Because I see that a lot. Mm-hmm. Yeah, it's the basic numbers. What's my purchase price? Engaging with a real estate attorney to negotiate that purchase contract. And what kind of due diligence can I do? What kind of warranties and representations? What kind of contingencies am I getting? Engaging with a lender to determine, what do I have to put down? What's the interest rate? What's the monthly payment amount? Is it going to be an 8-year loan with a balloon payment on the 8th year? Or is it going to be 10? What's the interest rate? Are there prepayment penalties? And then it's a matter of engaging the business attorney like myself to put together the Delaware LLC, the operating agreement, structuring the securities offering so that it's exempt from registration, obviously writing this prospectus, writing the subscription agreement, filing the Form D, and turning it back to the local real estate attorney for a closing.
So really, before someone comes to you, they really need to have that closing package pretty well together. Maybe not.
So you have to have a purchase contract signed. Mm-hmm. Have a purchase contract signed and have a situation where you either where the lender has given you a commitment letter at least. You know what that loan package is.
What about insurance?
Insurance can be done during the course of while I'm performing work.
Okay.
I have a very good referral to an excellent insurance broker who writes in 48 states.
Okay. So in terms of, so you've got the purchase contract in place, you've got a commitment letter from the bank. So we come to you, I guess we have an initial meeting, then what takes place?
I send the person out an engagement letter, they sign it, they pay an initial deposit, and then I get started. And I sit down with them during the consultation just before the engagement letter. We talk about what's the appropriate exemption. Is it Rule 504? Are you going in one state only for investors? That's frequently not the case. Is it 506B? Are you going to rope in some friends and family? Which is 506B is an unlimited dollar amount to 35 or fewer unaccredited investors. More and more frequently, I'm seeing just 506C offerings where it's going to accredited investors only with an unlimited dollar amount. Rarely I'll see someone pursue the crowdfunding route. Very rarely. It is more expensive legal fees wise because you're going to, and more delayed closing wise because you've got comments from the SEC and you can't go forward until you get green lighted by them. You could conceivably go all the way up to doing a Regulation A offering up to 20 million. But for many syndications and even a lot of private funds, that I've done one or two of those, but that's not very common.
Mm-hmm. Because of the
And
expense and it's
because of the expense, right?
And it's not necessary.
Possibly, yeah, it's not necessary.
Yeah. Okay. So you do the filings in Delaware. So what if the property is in North Carolina?
Still, you want to go with Delaware because you got to remember you've got a relationship with the investors. Delaware has a specialized business court. Many states do not. Delaware has the largest body of jurisprudence. If someone asks me, can I do this or can I do that? What are my investors' rights? What are my rights? And you don't want to be able to answer a client with, well, I don't know, but here's what Delaware would do. So it's really the reliance on that large body of law. Mm-hmm. And also some states are what we call foreclosure states in their LLC Act. Virginia and Maryland, that is the case. Mm-hmm. Any general creditor can at any time seize the membership units and execute on if that creditor is not going to be paid. Mm-hmm. So if you're if you're syndicating a property in North Carolina and all your investors are Maryland and Virginia investors picking up investing membership units, your investing members are probably going to be Amex, Visa, and MasterCard. If they don't get paid at the end of the month or for a few months, they're going to move. And you may be under a lot of pressure to sell that property way before you want to. Delaware is just a charging order state. Mm-hmm. Which means if one of your investing members doesn't pay their Visa bill, you will get a letter from a Delaware court saying, we are putting a charging order out on Johnny Jones's membership units. Anytime you send him distributions, send it to us instead until this dollar amount is met. Mm-hmm. But you keep the project.
Right. Yeah.
You don't have pressure from investors now to start selling.
Okay.
So it just gives you more certainty, more stability, and more control.
So with the syndication in an LLC in Delaware and the property in North Carolina or any other state, that is going to entail establishing a secondary LLC in the state, or else filing the syndication as a foreign entity.
As a foreign LLC. Right? So you could either go the foreign LLC route, or you could do a shell title holding company, all of whose membership units are owned by the Delaware LLC for the property. Mm-hmm. Some states, including Delaware, have advanced that and use it and allow you to use a series structure where you have one main LLC with the authority to create series. The debts, obligations, and liabilities of each series do not pass up to the main LLC, nor do they pass over to any other series, yet it is still one LLC. A series filing is cheaper. However, North Carolina does not permit you to use series. 22 states do.
Okay.
Like I've got a client who's a private real estate fund in Ohio. It's a Delaware LLC. Delaware and Ohio are both series states, so we're making extensive use of the series structure. Whereas when I get a client in Maryland, we're using the Delaware LLC for syndication. Now we're using a shell Maryland LLC just to own title of that property.
Yeah.
The shell pays the expenses, passes it up to the main LLC, which then distributes it. The shell basically goes almost to zero in the bank account every month after all the expenses get paid.
Enlightened investors, if you haven't done so already, Be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. So which is better, the Shell LLC or file as a foreign entity?
If you want to get a little more removal, that way the personal injury, if somebody slips, trips, and falls on the floor, go the local shell route, controlled by the Delaware LLC.
Is there a difference in expense between the foreign filing and the Shell LLC?
The shell is a little more expensive by $100, maybe $150.
Not significant then, huh? Yeah, okay. We are talking with Steve Rinaldi. He is an attorney. You can find Steve at Stephen D. Rinaldi PC, and I guess that's .com. Is that correct?
It's StephenRinaldiLaw.com.
StephenRinaldiLaw.com. Okay. So, Stephen, you operate in, are you in Delaware or you just do the
I'm in
filings
Maryland. I'm admitted in DC,
Okay.
Maryland, and Pennsylvania. I've handled syndications nationally. Like I said, I'm working on a private real estate fund doing affordable housing in Ohio right now. Just finished that up. I had a client who bought agricultural land in Western Michigan. They're investing in apple orchards. And we're syndicating out various parcels of the apple orchards. We just did our first parcel about a month ago.
Interesting. So so each investor, they get a couple of acres? Is that how they're portioning
No,
it
it's
out,
not a tick structure. It is an LLC, just like a syndication.
Oh, okay. So they're just getting shares
Just,
of the
yep,
LLC.
the
Okay.
managing member, investing member. It's
Okay.
being syndicated out just like an apartment building.
Okay. Yeah, interesting. I've started hearing about agricultural investments, and they sound intriguing to me.
Yeah.
So, what is new in the Securities and Exchange laws? I'm hearing that there is probably some changes coming in conjunction with accredited investors.
Possibly. The SEC is talking about changes at this point. They're studying it. Nothing has been finalized. They periodically talk about it, but nothing has been finalized. I mean, if I had my druthers, I would at least raise the accredited investor amounts with inflation.
Yeah.
I think that's what would make the most sense, but I don't know if they're going to do that.
Well, what is the difference between a fund and a syndication? And
A
what's
huge difference. Syndications basically affect two areas of federal and state securities laws. Basically, the federal, you structure it so it is exempt from registering under the 33 Act, using either Rule 504, 506B, or 506C, or possibly crowdfunding, or maybe even Regulation A. If you're going over 20 million, Regulation A plus. But on the state side, again, you structure it so it's exempt from registration using, again, the specific state exemption or Rule 506B or Rule 506C, which most states have followed. Syndication really only implicates two areas of law in securities. The Federal Securities Act of 33 and the Uniform Securities Act on the state law side. A fund gets more complicated because not only do you have to structure it to comply with the Federal Securities Act of 33 and the State Securities Act, but you do not want to register as an investment company. And the most applicable registration to someone who's setting up a private real estate fund is called a 3C1 exemption. And 3C1 means you're offering to less than 100 people. If not, if you go over 100, you are going to have to comply with the Investment Company Act of 1940, which means you're going to be subject to restrictions on capital structure. You're going to be subject to having to create a board of directors, restrictions on the board of directors, conflict of interest rules, etc. So almost all private funds find one of the exemptions, anywhere from 3C1 to 3C7, the most common being 3C1. by far. The next area, so that's 3 areas of law that are implicated, not 2.
Mm-hmm.
Now we go to 4, federal investment advisor regulation. If your fund is less than 150 million in total, you do not need to have to obtain the services of a registered investment advisor to act as an advisor. And now we go into the 5th area. Here's where you hit the shoals or the rocks as you're sailing along. State investment advisor laws. Only South Dakota and New York federal follow the federal $150 million exemption. Everybody else does something different. My state of Maryland, you must use a registered investment advisor to be the advisor of your fund unless you are soliciting from qualified clients. A qualified client is someone who has 2.2 million to invest or 1.1 million with that particular investment advisor. So it's a category much higher than accredited investors.
Mm-hmm.
My other states, like say Georgia or Florida or Pennsylvania or Tennessee, or I think North Carolina, Ohio, have a limit on the number of investors. You don't need a registered investment advisor if you stay under that limit. And that can be 2 or it could be as high as 15, depending on the state. Some attorneys say that that number is triggered by the number of funds you offered, not by the number of investors. I'm more cautious and conservative. I don't want to put someone out there and then 2 or 3 years into a fund have an investigation because the state securities agency says, no, we really mean its number of persons. And it's our word against yours, we're going to win. So I just play it very conservative. There are about 18 states where it is extremely difficult to impossible to offer a private real estate fund to investors. The good news is, other than the state of Washington and maybe one other state, Colorado, you're not going to get any investors from those states. I mean, how many qualified clients are there in West Virginia or Kentucky? So we wouldn't be looking there.
Yeah.
It just doesn't matter. One of the most recent securities offerings I did, the private hedge fund, that is going to qualified clients only. The private real estate fund is accredited investors because one of the 2 managing members is himself a registered investment advisor and can serve as the advisor to the fund. So funds are a little more structuring. The big takeaway on the fund thing for the non-lawyer is, I have a pile of cash that I can deploy immediately. I don't have to run out. I've already got my investors. And I can go to the bank and say, look, bank, I've got 10 million from investors to buy X number of properties in this state with X number of units. You know, the parameters of my fund are, these are the units. This is the vacancy rate I want. This is the repair range, the cash range of repairs I'm willing to make on each. This is the local unemployment rate. This is the local job market. This is where that local economy is going. And if you stay within those parameters, you're fine.
So
when you write the parameters in the prospectus, you can't really deviate from them.
Yeah.
So funds involve a lot of targeting. What do I want? But you've got the cash. At that point, you can go to a lender. You can move, whereas somebody else is in a syndication is out just raising cash.
Right.
Funds are a good alternative for someone who's done 2 or 3 syndications and really knows what he or she wants or doesn't want. And just wants to have the cash available to move.
Yeah, a lot of complexities there. And then also, I mean, the funds come with fees that the syndications don't.
Yes.
I mean, not that syndications are free of fees, but funds have a great deal more, and they're a lot more expensive. Is that not correct?
If there can be more fees because you're charging an asset under management fee, like the total amount that you've raised, you are charging that fee. There can be a management fee associated with the funds in addition to AUM. You know, a 1 or 2% management fee just going to repairs, etc. until the cash flow starts to pay for the repairs, or the management fee can continue.
So you have to watch those fees if you're going
Right, you
into a
have to,
fund for sure. Yeah. Well, I've got a question for you. So, say I have, I don't know, five or six individuals. We just want to get together and invest in a syndication. Can we just do an LLC and have the LLC invest in that, or does that become a fund?
that can become a fund. That can very well become a fund. Now, is it worth it if you got 5 or 6 people who are looking to stay passive but invest in various projects and not?
Mm-hmm.
And one person is kind of a good lead person. One person might be an RIA, et cetera. It might be worth establishing an investors fund, or it might not.
Yeah.
It depends on the facts and circumstances.
So another question. So if you're in the LLC is the one investing in the syndication, and it is a 506C, does everybody in that LLC have to be an accredited investor?
Yes, and if it's a fund structure, depending on the state, if you are not a registered investment advisor and you have, at that, if you got Maryland or Virginia investors in, it's qualified clients. It's one step up from accredited investors. If it's Pennsylvania, you stay under the Pennsylvania limit, which I believe is 5 or 6.
Yeah.
If it's New York, you just stay under 150 million. You're fine. That's the state investment advisor law, and the necessity to use an investment advisor with a fund that is heavily state driven and varies wildly from state to state. And one of the things I'll do with the client in an initial interview is just see where are your investors coming from to determine the most appropriate structure. So you're not violating any federal or state securities laws or regulations.
Well, in closing out, Steve, and by the way, we are visiting with Stephen Rinaldi, and you can find Stephen at Stephen Rinaldi Law.com. Did I get it right this time?
Yes, you did. Thank you
Okay.
very much, Alan.
So that's Stephen Rinaldi Law.com. So Stephen, close us out by telling us one of the biggest disasters that one of your clients has experienced.
On the syndication side, fortunately, there have been no disasters. Usually the client has disasters when they don't go to an attorney first. The only disaster I can hear, a person who has, they've never became a client, but they call me from time to time, and they invested with a group of other people in a property in Columbus, Ohio. It was put together by a local title attorney who charged them just $400. No prospectus, but it's just for them. I don't need to do that. Well, the investors started bickering and squabbling, and sure enough, one went to the Ohio Division of Securities. Refunds to all the investors, which of course means you're below the capital and the bank loan amount. You got to sell the property. So not getting things right can cause you to have to sell that property.
So always a wise thing to do is to put the money up front and get the proper legal advice.
Right.
And stay out of trouble. And not only stay out of financial trouble, but keep yourself out of jail, because you don't want to be in trouble with the Securities and Exchange Commission.
Yes, and more frequently on the syndication area, it's state securities agencies. If you're raising less than $5 million, the SEC does pay attention to that, but the states really pay attention to what's under $5 million. Once you go over $5 million, then the SEC's radar is always up.
Yeah. Well, Steve, it's been wonderful having you back with us again today. And Enlightened Investors, Stephen is a previous guest. He was on our previous podcast, Creekside Chats with Successful Real Estate Investors. And you can find him at episode 79 and 129. So, Enlightened Investors, thank you so much for being with us again today. I know you got a lot out of this, and be sure to consult your attorney before you take any actions. And Stephen is a good attorney to go to. So, If you've enjoyed the show, please leave us a rating and a review on your favorite podcast app. And until next time, live abundantly, and we'll see you in the next episode.
Thank you very much for having me, Alan. Everybody, good luck on your next transaction, your next syndication or private fund transaction.
Thank you, Stephen.
Thanks. Bye-bye.
Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off passive real estate investments, then you'll want to immediately go to stevetalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to stevetalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.